Hello and welcome. Today we're going to talk about asset allocation, balancing risks and rewards. Before we get started, I just want to introduce myself. My name is Kim Kennedy, and I'm a financial consultant with Alliant and Retirement and Investment Services. Hope this is informative and you learn a few things today. So let's get started and talk about why asset allocation is important. Before we jump in, I guess I should point out some of the educational resources that we have available through Alliant. We have a number of financial consultants conducting webinars on various topics every week. So check out our link, our events link, and you can log in and join, sign up for any of those. We also do a podcast, and all of those topics, past topics, are recorded and out there in our podcast library. So take a look there. And then lastly, we do have a website and a blog that has a great amount of resources there. So if you're looking for something, a specific topic or a specific financial or retirement related question, check either of those sites, and I think you'll find we might have something to help you out. Okay, now let's get started. The topics we're going to focus on today is understanding how and what asset allocation is and how it works and why it's important for you. You're going to have some more insights into the different types of investments used to build an asset allocation and give you some pointers on how to look at your own asset allocation and what changes you might need to make if necessary. First, let's review what asset allocation means. Basically, it's dividing your investments between different asset categories, such as stocks, bonds, cash, or cash equivalents. The mix of these assets, or how much goes in each category, should be determined by you, your investment goals, your time horizon, when do you need the money, and your ability to tolerate risk. It's no good to say, yeah, I want to be risky, and every time you get a statement in the mail, you have an ulcer if your account is down. So it also doesn't necessarily mean that you have an account at Fidelity and Vanguard or Schwab, as all of those accounts could be invested in the exact same asset category, even though they're at different companies. There's a lot of investment options out there: stocks, stock mutual funds, corporate and municipal bonds, bond mutual funds, life cycle funds, exchange traded funds, money market funds, and U.S. Treasury securities. I'm sure you've heard a lot of those words, but all of these options boil down to three basic categories: stocks, bonds, cash, or cash equivalents. And these three asset classes come with different levels of risk and returns. So let's dig into these categories. Simply put, a stock represents ownership in a company. You own 10 shares of IBM, you are a 10-share owner of that company. A bond is basically an IOU that a borrower, such as a government organization or a corporation, gives to an investor with a promise to pay them back their principal with interest in the future. So it's a loan. And lastly, cash and cash equivalents are short-term investments such as treasury bills, CDs, things that can readily be converted into cash. So that's why they're sometimes called cash equivalents. So when you think about asset allocation, it's a way to keep us from putting all of our eggs in one basket, so we can do a better job of balancing potential risk while trying to get a good potential return. And experts would say that asset allocation, sometimes called diversification, can be one of the most important decisions an investor can make. So let's take a look more closely at each type and how it's performed. The chart you're looking at, sometimes called the quilt chart because it looks like a patchwork quilt, actually shows you historical returns of different asset classes, ranked from the best performing to the worst performing each year. Now, if we knew which type of stock or bond would be the top performer each year, we could put all of our money in that type of investment, but we don't. So pick any color on this box and draw a line from left to right. Notice there's a zigzag pattern, right? Notice that one year what the top performer was, the next year can be the bottom of the list. For example, look at real estate in 2020. The dark purple at the very bottom was a negative 11.2%. And then in 2021, you can see real estate was the top performer at 45.9%. And then 2022, it dropped back down. So the point is, we don't know which asset category is going to do the best. So either we need some and all of them or a portion of them. And the white shows you a diversified portfolio. So you can see it's not the top of the list and not the bottom, but more of a mid-range. But there's less severe ups and downs, right? Think of mountains and peaks and valleys, but with the diversified, it's more centralized. The mix of each asset type determines the risk of the portfolio, meaning how much do you have in real estate or stocks or bonds. So here's a chart that shows you how each type of portfolio will potentially return and what your potential risk is. So along the y-axis on the left-hand side, going up, that's the return. So the higher on the left-hand side, the more return that investment mix returns or provides. And then along the bottom is the volatility, is another word for risk. So the further to the right, the more risk you're enduring. So a conservative portfolio you can see is low and to the left, and then going forward in risk, you see the return goes up, but also the risk increases. So let me give you just a brief overview of what a conservative portfolio might be. It might be all cash equivalents. A moderately conservative might be 25% equities and 75% bonds. A moderate might be a 50-50. A moderately aggressive might be 60 to 75% stocks and 25 to 30% bonds. And an aggressive portfolio is going to be all stocks. Well, how do those types of investment categories perform? Well, let's take a look at this chart. So this is showing us for each portfolio type, asset mix along the bottom, cash, moderately conservative, moderate, moderately aggressive, and aggressive, how each of those portfolios performed in their best year in light blue, their average year in navy blue, and their worst year in red. So you can see, if you just look at the averages, you can see that the average on the conservative portfolio is 4%. And then we go to 8, and then 10, and 12, and 13. So it gives you a good idea of, on average, what each asset mix portfolio would return. And then there's certainly some outliers, the best years in blue, lighter blue, and then the worst years in red. So if you're not sure how or how much you want to invest in different categories, you may want to look at an option of a mutual fund, which is typically what's available in employer 401k plans. And what's good about this is it makes it easier for you to diversify because they pull money from a number of investors into a fund. So there is a common objective and there is a pool of stocks. So you're not trying to pick one stock. And the mutual fund may have, I don't know, 60, 80 different stocks. So if you think about that, if 5 of the stocks in the fund are down, but 75 are up, you're okay. So you're diversifying your risk by not putting all your eggs in one stock basket, so to speak. Mutual funds are overseen by professional fund managers. They're making the decisions of which stocks or bonds to buy or sell. But there are specific choices that you can take a look at, again, depending on your risk tolerance. And generally, you can have the dividends that the investments spin off reinvested into more shares, or you could also have it sent to you as an income distribution. And certainly, the returns can be up and down, and it can impact your principal, right? It's going to fluctuate, just like the chart we saw on the previous page. So what's your current allocation? Do you have any idea? Take a look, pull all your retirement plan statements, investment account statements, bank accounts, and gather that and take a look at the mix. Maybe you need to do a questionnaire to determine if your asset mix is in line with your risk tolerance, timeline, and goals. I run into clients that tell me they know they're invested conservatively, and then when we take a look at their investments, that's not the case. And then vice versa. People think they're invested aggressively and that's how they want to be. And as it turns out, their investment is actually conservative. And sometimes what happens is you buy or you select investments and then you never change them and they sit there for 5 or 10 years. And then all of a sudden that mix isn't the same because one asset class did better or one did worse. So that overall mix percentage has changed. And you may have a different asset mix for different goals. So take a look at your goals, whatever they are. It's time to start building or fine-tuning your strategy. So take a look. I mean, building an emergency fund is maybe the first goal, right? I mean, what if something goes awry? You need to have money set aside in case. So you might invest that in cash equivalent, something safe, right? Maybe you're going to buy a new home in the next 5 years or so. That might require a different type of an asset mix. And putting your kids through college, if you start when they're young, you have 18 years before they're going to go to school. And then lastly, retirement. That certainly is what everybody strives to generally. And that's 10, maybe 15, maybe 20 years away. And that's something you need to think about too, because once you retire, you are probably going to live, 25, 30 years, right? It's a third of your life. So we can't lose sight of that long-term goal, even though we have these short-term goals along the way. So what are your goals? Your goals and timelines are the biggest factors in how you decide how to allocate your money. And you need an appropriate mix for each, like I've already suggested. And if you want to grow your money, and who doesn't, your investment is likely, your allocation investment is likely to include some target growth, such as stocks. If you're less inclined to take risk, you might want to be allocated a little more conservatively. And everybody's got their own opinion about what their most important goals are, right? We're all not cookie cutters. Everybody's unique. And that's the way it should be. But I would like to point out that saving for retirement is probably one of the most important goals, again, because we're going to spend a quarter to a third of our life retired. So after you've established your goals, then the next step is to determine your personal tolerance for risk. How can you make it work within your timeline? Your risk tolerance depends on a lot on your timeline. If you have 20 years before you need the money for your goal, you might want to consider investing in more stocks because you'll have more time to ride out any short-term ups and downs. And you need to keep in mind that holding a particular stock for 20 years certainly comes with no guarantees, and you may still lose money. I'm going to take a little break here and share a little story about a client that came through our offices, and she, the whole idea of diversification is spreading out your money. In her case, she decided that she wanted to take some money and she invested in this company that had this really cute little icon of an apple. And she bought the stock because it was a cute little apple. And she has, over $6 million now because she picked a stock that had a cute little icon. So that's not going to work that way for most of us, which is why we want to do some diversification. So Let me jump back into the goals. If you need your money in 5 or 10 years, you may want to be more moderate. A lot of investors choose bonds and money markets for short-term goals, and more moderate investments in stocks. And as you approach the time frame when you will be liquidating your investment to apply towards your goal, you need to remember to review your allocation. If you haven't accumulated enough for your goal, you may want to consider a more aggressive allocation to try to make up the shortfall. And again, the important thing is you always need to consider how much risk of loss you're comfortable with. And everybody is different. I have clients that say, generally, as they get closer to retirement, they're more concerned about keeping what they've accumulated and not losing it than they are about making a 20% return. But even younger people that are a ways away from retirement, some are very comfortable being all in stocks, and they know that's the right place for them because they have so much time, and other people aren't. So it's your time frame for sure, but it is definitely your comfort level. As I mentioned earlier, I don't want anybody getting an ulcer when they open their quarterly statement. So here's some examples of goals and timeframes you can think about and how you might allocate your assets to pursue these goals. We've set up some sample portfolios. So let's just kind of look through this. Emergency funds. You need to be prepared for unexpected job loss, illness, or something else. So your time horizon is as soon as possible. And generally, the rule of thumb is to accumulate 3 to 6 months of living expenses in that emergency fund. Maybe you need a major purchase, such as a car or a home, and you want to do that within the next 2 to 5 years. That might be a different type of asset mix. And an accumulation goals to prepare for a child's retirement that's more than 10 years away. Maybe you've heard about 529 college savings plans. You can invest, if you start when your child is young, they have these age-based portfolios. You've got maybe 18 years until your child goes to school. You can put your money in something based on your child's age, and it starts out aggressive and it automatically ratchets down to being more conservative by the time your child's 18 and ready to go to school. And then the last one talks about wealth preservation to ensure your retirement plan stays on track. And this is kind of what I mentioned earlier, that once you retire, you may live 20, 35 years, 20 to 30 years, and you need your money to last as long as you do. So maybe you want to be less concerned about, big stock market gains and more concerned about keeping what you've accumulated. So let's dig into the emergency fund goal a little bit. This is a goal or a pot of money that you need quick and easy access, right? Every investment, there are three things that we have to balance. Liquidity, meaning how quickly and accessible is your money, risk, and then return. And every investment out there, think of that as a triangle, and each of those points need to be considered. But setting aside money for an emergency is an example of hoping for the best, but planning for the worst. It's recommended to have 3 to 6 months of living expenses in your emergency fund. And if you don't know what your living expenses are, then it's time that you set up a budget. So do that if you don't have one of those already, because you wouldn't know how much your living expenses are without one. What if you lose a job? It'll take you some time to get a new job, and certainly you need to pay your bills in the meantime. And what about an unexpected expense, a car repair or a new heating and AC system for your house? I've talked to people that's, a $15,000 expense. And if you have money in an emergency fund, it helps with these situations, and you don't have to end up relying on credit cards, and then that's another situation you need to get out of. Generally, you don't want to risk your emergency money. You want it to be accessible when you need it. So lots of folks start with high yield savings accounts because they're liquid, they're accessible, they're insured. But some other things might be CDs and money markets and those types of investments. A major purchase, if you're planning on buying a home or a car in the next 5 years, you may want to consider a moderate growth portfolio. In this hypothetical example, you could see that 60% is invested in stocks and 37% in bonds, and then the remaining, 3-ish% is in cash and tips. That's a fancy way of saying treasury inflation protected securities. They're bonds issued by the US Treasury that helps to guard you with inflationary impacts. So that might be a mix of something you want in the next 2 to 5 years. In my opinion, this slide says 2 to 5. I tell folks, if you need the money in 3 years or less, I don't want any risk to the money. So I might be a little different than what this is showing if it's something you're going to buy in less than 3 years. All right, accumulation for longer goals, retirement or maybe college expenses down the road, you probably want a portfolio that's a little more aggressive. Again, if you're comfortable with that, you'll take on more risk, but you'll have the potential for more rewards. The longer timeline should give you the opportunity and confidence to ride out any short-term fluctuation that comes along. In this hypothetical example, an aggressive portfolio, 5% of the investment is in bonds. So remember, bonds are safer, and 95% is in stocks, right? So that's the ownership of the company, and you have more upside, certainly more downside as well, but longer term, ride out the fluctuations. But keep in mind, though you may want to modify your allocations as you approach the date for accessing the money, like your kid's college or whatever goal, if your 10-year goal is for your own retirement, you may want to add other things to the mix, right? In your 401k, IRAs, those types of investments. Okay, preserving your wealth. A conservative portfolio is often used for wealth preservation. So this is, you rolled the clock forward, you're retired. Now what do you do with your money? How do you invest when you're retired, when you don't have a paycheck anymore? And this type of portfolio can help retirees make their savings last. The question I get all the time when I am talking to retirees or pre-retirees, when I ask them about their concern about retirement, the first thing they say is, I don't want to run out of money. No one wants to outlive their money. So in this hypothetical allocation, it's designed to do that with mostly conservative investment that can help you protect what you've saved over all these years. And you can see it's mostly in bonds and some of the other categories. So it may be a long time, maybe 25 years before you plan to retire, but you could live another 30 after that. So the goal of conservative portfolio is to provide investment income and help you guard against the risk of inflation. And I would say, as I meet with folks that are even approaching retirement, they're getting close. They're 5 years out, they're 4 years out, they're 3 years out. And if the market has been going well, it makes sense to maybe take some of those gains off the table and protect a portion of the retirement portfolio before retirement arrives, right? The last thing you want to do is you retire and then you're ready to change everything and the market drops 20%. So I see people working towards that more conservative, preserving your wealth attitude prior to retirement. Okay, let's talk about risk and how you might want to manage it. These two charts give you an idea of two sample portfolios and their performance over the same 30-year period. So on the left, we have 100% stocks, and over 30 years, that portfolio generated just under 10% a year. And then the risk level, so you can measure risk, and that number was 17.2%. So the higher the number, the higher the risk. The portfolio on the right has a little more asset allocation or variety or different asset categories. And this one was comprised of 60% stocks, 30% bonds, and 10% cash. So this one returned just under 8.5% over the same 30-year period, so about 1.5% less than the all stock, but the risk number was just under 11%, so a lot less risk. Certainly, history is no guarantee of what will happen in the future, but this does illustrate how taking on less risk will generate roughly the same amount of returns. When one zigs, the other zags, right? And allocating your investments is not just a one-time decision, and you need to recognize that you may need to make adjustments based on what's going on in your life, right? The other thing I would say is if you don't know what you have, it's a good time to get started, right? Other drivers are when your job changes, when you get married or divorced, or you have had a child. These are just a few examples of the kinds of changes that could signal it's time for you to review your financial goals and your allocations. I recommend that you review your asset allocations at least once a year, even if there haven't been any big changes in your life. You might discover that market performance has shifted your allocation and you don't even know it. So you might be out of your target allocation just by how different categories have performed. And as I mentioned earlier, you also need to consider allocation changes as your timeline shortens for certain goals, such as kids going to school or retirement. If all of this seems a little overwhelming or confusing, you're not alone. There's a lot to digest, and you may want to seek help from a financial professional, and we're happy to help you with that. But some of the other things, that a financial professional can help you with is help you establish your goals and the timeline, help you understand what your risk tolerance is. As I mentioned earlier, people say, "Oh, I'm moderate or I'm conservative," but their investments and what their words say don't add up. So there are questionnaires that people can provide you you can answer the questions and see if that lines up with how your investments are allocated. So we can help with that. We can help you develop asset allocation strategies and to help you manage the risk. And then lastly, there's some other helpful resources out there. I mean, the internet, you can go to a prominent firm's website and they have lots about asset allocation and helping you determine your risk. Networking groups, investment clubs, any kind of professional business group can be helpful. And I'll finish where I started. At Alliant, we have quite a few resources as well, the webinars and the podcasts. Our website and our blog has all kinds of things out there. And, the bottom line is the more information you have, the better prepared you'll be. Don't bury your head in the sand. Just take the bull by the horns, learn some of this, even if it's Greek to you, and get some help. You will not regret it as you are able to do a better job and achieve your goals quicker. So with that, I'd just like to thank you for joining us today.